Your bank account is bleeding dry because of a trend you didn't even realize was engineered to fail. Last Tuesday, thousands of influencers pushed a specific liquid supplement that cost followers exactly $300, only to vanish from shelves 48 hours later. This isn't bad luck. It's a calculated churn and burn strategy. To stop losing your money to these digital traps, you need to recognize the three specific red flags that define every manufactured trend. Glass of water, and let us get to it. We are constantly bombarded with the idea that we are missing out on the next big thing. Whether it is a meme stock, a new cryptocurrency, or a supposed breakthrough in biotechnology, the psychological pressure to jump in is immense. But have you ever wondered why you feel that sudden, sharp urge to buy when the price is already at an all time high? That is not an accident, that is by design. The first, easiest way to avoid this trap is to recognize the power of the volume spike. When you see a sudden, vertical surge in trade volume paired with a price increase on the news, you are likely looking at the late stages of a hype cycle. Think back to the GME situation in January 2021. People who bought when the volume was at its absolute peak were the ones who paid the heaviest price when the inevitable correction arrived. A study by the University of Maryland found that retail investors who chase stocks with massive social media sentiment spikes typically underperform the market by over 20% annually. It is an easy win because you do not have to predict the future. You just have to learn to step back when everyone else is shouting. Once you train yourself to stop chasing the noise, you start to see the patterns in the market that most people miss. Now, here is where things get interesting. The second, more advanced method for protecting your capital involves analyzing the difference between institutional flows and retail FOMO, which stands for fear of missing out. Institutional investors, like pension funds or large hedge funds, do not trade based on a viral post. They use complex API integrations and high frequency systems to slowly accumulate positions over weeks or even months. If you check the data on the SEC filings or look at the distribution of trade sizes, you will often find that the big money was entering while the asset was boring and unpopular. When the hype finally hits your feed, that is often the exact moment they are looking to exit their positions to provide liquidity for the retail buyers. I remember a friend who put his entire savings into a trendy renewable energy stock back in 2022. He saw it all over his feed, bought in at the peak of the hype, and watched his investment lose 60% of its value in under 2 months. If he had looked at the insider transaction reports, he would have seen that the company executives were filing to sell their shares 3 weeks before the hype cycle peaked. It is a tough lesson, but once you start following the actual movement of money rather than the volume of voices, your entire perspective shifts. If you are finding this helpful, hit subscribe. I drop videos like this every week to help you navigate these markets. If this is clicking for you, a quick subscribe helps me keep making these for you. Now, okay, remember how I said the best one was coming? Here it is. This is the one I have been saving for you. The third and most powerful method is something called the sentiment reversal signal, and it is a tactic that professional contrarians use to generate alpha in even the most volatile environments. Most people look at news to decide if they should buy, but you should be using news to measure how much market sentiment has been exhausted. When you see mainstream news outlets like the Wall Street Journal or Bloomberg running a feature on a specific retail trend as a massive opportunity, that is not a buy signal. That is a final warning. This is based on the concept of the late majority. By the time your local morning show or a general interest publication covers an asset class, the initial innovators and early adopters have already moved on. A famous example of this is the dot-com bubble of 1999 and 2000. Magazines were putting kids who made millions in their bedrooms on the cover while the underlying business models were falling apart. When the public finally feels safe enough to invest in a trend, the smart money has usually been out for a long time. I once tracked a specific technology sector for 18 months. When the sentiment reach was at its lowest point in the summer, the valuations were incredibly attractive. Over the next year, the sentiment grew until it was the most talked about topic at every dinner party. I waited for the peak sentiment coverage, sold my position, and captured a gain of over 400% while everyone else was just starting to open their accounts. That one shift alone could save you more than the first two methods combined. Once you see it this way, you cannot unsee it. You stop seeing hype as a signal of value and start seeing it as a signal of saturation. It is the difference between being a victim of the market and being a strategist within it. So there you go. 3 real ways to stop hype from destroying your returns, and the last one alone could change your entire financial picture. We covered the danger of volume spikes, the reality of tracking institutional flow, and the power of the sentiment reversal signal. If you got value from this, share it with someone who needs to hear it and subscribe so you do not miss the next one. I am putting together a piece for next week on why most people get the concept of diversification completely wrong, and trust me, you are going to want to see that. Take a moment to think about your current portfolio. Are you holding things because you did the work and believe in the asset, or are you holding them because you are afraid to miss out on the hype? That is a question only you can answer, but it is the most important one you will ask yourself this year. The market is not there to reward your enthusiasm. It is there to reward your discipline and your ability to look past the noise. So keep your head clear, do the research, and let everyone else chase the headlines. You now have a better way to operate, and I will see you in the next one. It really is as simple as that. Just stay patient, stay quiet, and let the hype burn itself out while you build real, sustainable wealth. See you next time.